Thank you for sitting down to talk to me about the Munro Climate Change Leaders Fund and the year it's had for 2025 and what a year it's been. Do you think you could start us off by talking about performance over the last 12 months?
Yeah, sure. Thanks, Taylor. It's been a good 12-month period, but it's probably a continuation on the year before that and a little bit before that as well. So really the big change over the last couple of years has been this change in the power demand situation in the US in particular, which has really been brought about by increased demand coming from data centres, from the electrification of the economy, and probably lastly from reshoring, some of these heavy industries coming back to the US. And so really the beneficiaries of those industries returning or building are basically a lot of the climate leaders that we actually invest in this fund, because they are the people that are building this power generation, or they're building the transmission lines, or they're building the batteries that go behind a lot of the plants that are going to be started up, or a lot of facilities that are going to be started up. So if you think about it in those terms, that's really the type of beneficiaries that we're looking at. Then when you sort of extend out, you say, okay, well, it's been a couple of good years. Have I missed something here? When you think about it, it's been a 20-year underbuild situation before that. So you're really only a couple of years into potentially a multi-decade sort of improvement in the backdrop for a lot of these companies. So yeah, we're 2 years into what's hopefully a longer-term structural growth tailwind for build-out in the US in particular.
So you sort of already answered it, but maybe you could provide a tiny bit more detail about the key drivers to the fund's success for this year.
Yeah, so they've come in the two areas. So I just touched on the power generation sort of side of things and the improvement there. The other way to think about it is obviously if you have a situation where maybe power is a bit tight, you actually have to be more efficient on the other side as well. So the other part of the portfolio I didn't talk about because it's probably not quite as sexy is actually the energy efficiency stocks as well. So when you think about it, we speak to all these companies across many sectors, mining sectors, agricultural sectors, retail sectors, etc. And they've all got net zero targets by 2050 and they have interim targets as well. So they have to sort of show you their steps along the way to get to that net zero. And if you just think about a basic example down the road here at BHP, they obviously have net zero targets in place and they have to show that they're basically working towards that. And so on the energy efficiency side, that's just a natural first place for them to start. They can't decarbonise their mine operations because electric vehicle trucks at that sort of tonnage don't exist today. But what they can do is decarbonise their head office in the CBD. And so what does that involve? That involves looking at energy efficiency across the board, so insulation, lighting, and also heating and cooling as well. And so the fund also invests in a lot of companies that provide this sort of industrial equipment as well. So an area like HVAC, heating, ventilation, air conditioning has been a great area for the fund as well over the last 12 months, 24 months as well. So it's been both sides, the power generation side, but also just using less power as well.
So previously the strategy had positioned away from the clean transport sub area of interest, but this year it did make a comeback. Can you tell us what changed?
Yeah, sure. We've been out of the EV side of things for quite some time. And just as a recap, the last few years you've seen a huge amount of Chinese supply hit the market. So there's over 100 brands in China basically building EVs. EV penetration in China is going through the roof, but the companies aren't necessarily able to leverage that sort of industry growth because the competition is too high, so the price points are coming down, so therefore the company margins are also coming down as well. And so bottom up, we haven't liked this sector for a long period of time. Now you're right, we have come back to this sort of area, but we're not investing in the car companies themselves. We're basically investing in their suppliers. So we like the power semiconductor companies that go into the EV to basically allow the car to drive, because that's a consolidated market of suppliers. But an area we like even more than that actually is the battery side of things, because there's around about a half a dozen battery suppliers into these EVs. And so the market's a lot more consolidated. And there's one company that we think is emerging as an industry leader, and it's actually taking market share and growing its margins. And so that's a business we've invested into to basically leverage this EV growth without actually buying an EV brand itself. So that company's called Cattle.
And so President Trump created a lot of volatility throughout the year. From a political perspective, how does 2026 set up for climate-related stocks?
Yeah, Trump has created a lot of volatility. I just sort of encourage investors, I know it's difficult, but to try to block it out a little bit. I know the headlines are quite negative because he's prone to sort of quite negative comments like the green news scam, for example. So all else equal, you'd think, oh, decarbonisation is off the agenda in the US, which is obviously the dominant market. However, when you actually look at what he's actually done, a lot of it's actually been quite positive for decarbonisation. So first of all, he's obviously very positive on the nuclear industry, which is zero carbon emissions. So as a bottom-up investor, we can go and look at some of the suppliers in that industry as potential beneficiaries of his agenda. And then just on the mainstream side of things that he dislikes on the renewable side, he actually has extended a lot of the tax credits under the Biden regime forward and not removed them as the market sort of had fretted around these headlines, simply because they actually are good for business. And a lot of these industries are calling for certainty. And so he hasn't been the disaster that you'd think that the headlines suggest.
And so were there any notable stock-specific success stories this year?
Yeah, so as I say, they've sort of mostly come in this clean energy side of things or energy efficiency. And a lot of them have also come in the US because the US is the economy that's probably building these data centers the quickest. It's electrifying the economy and it's reshoring these heavy industries as well from China. And so a lot of the action has been in the US. And when you think about it, where does that sort of lead us? We basically follow the money. At the end of the day, someone has to build all of this sort of stuff. So I'll give you two examples. One of them is Quanta Services. The other one's a company called Comfort Systems. Both of them are based in Texas, where there's a lot of activity, obviously. And both of them are basically employers of blue-collar skilled labour. And so in the case of Quanta Services, they're the ones basically connecting these wind farms in the middle of nowhere to the population centres with these high voltage electricity lines. So they're doing all of that work. They're connecting solar farms, install batteries, etc. So basically every time the utility wants to build something, they're the ones that get called to do that work. Comfort Systems are a little bit different. They're actually plumbers, or the majority of them are actually plumbers. And so when you're talking about that retailer or that industrial company that wants to improve the footprint of their manufacturing facility or their office building, Comfort Systems are the ones that go out and basically do that sort of piping work and that HVAC work. So there are a couple of examples of just people doing the work, and they're sort of under the radar when you think about climate change. But at the end of the day, someone actually needs to do this work. You can't have a decarbonisation agenda without someone connecting the electricity or connecting the renewable.
And so how are you positioning the portfolio heading into 2026?
Yeah, I'm afraid it's much of the same, to be honest. After a couple of years, you'd be thinking, have these stories run too hard, or is this story sort of maturing? Should you be looking at something else that's sexy, EVs, solar panels, wind turbines, all the sort of things you think about decarbonisation? But at the end of the day, we're probably 2 years into a recovery in these type of companies' prospects. 20 years before that, for these companies that I sort of just talked about, your Quanta Services and so forth, they've been pretty miserable because you've had no demand growth. And so you've basically got 20 years of catch-up of underinvestment, poor infrastructure. They can't do this work in 2 years. This is a 10-year backlog of work, effectively. And so there's no real need to sell those stocks and move on to something else because you've still got a really strong earnings growth pipeline for the next few years.
James, thank you for talking to me about the year in review, and I look forward to talking to you in early next year.
Thanks, Tara.